Hey everyone, welcome back to Sara Retires. If you've spent any time researching retirement, you've probably heard of the 4% rule. The idea that you can withdraw 4% of your portfolio in your first year of retirement, adjust that dollar amount for inflation every year after, and have a very low risk of ever running out of money. It's one of the most repeated numbers in all of personal finance. It's in dozens of best-selling books. Surveys show a meaningful share of younger investors are literally planning their entire early retirement timeline around it. Here's the uncomfortable part. When researchers went back and corrected for some serious biases in the original data, the realistic safe withdrawal rate came out much lower, somewhere between 2% and 3%. Depending on your portfolio and how long you expect to live. Today I want to walk you through exactly why that gap exists, what the research actually found, and, importantly, why this isn't as scary as it sounds once we talk about how real people actually spend in retirement. I'm Sara. This is Sara Retires. Let's get into it. Where the 4% rule actually came from. To understand the problem, we need to understand the origin. Back in the mid-1990s, a financial planner published research testing how long a portfolio split between U.S. stocks and U.S. bonds could sustain various withdrawal rates, adjusted for inflation each year. Testing against historical U.S. market data, he found that a starting withdrawal rate of 4% held up reliably across the historical periods he examined. That became the famous 4% rule. It's a genuinely useful, simple idea, and it's easy to see why it spread everywhere. It gives people a clean, actionable number. The problem is what it was built on. Problem 1. The 30-year assumption may be too short. The original research assumed a 30-year retirement. For a lot of people historically, that was a reasonable assumption. But today, with people living longer, a 30-year window may simply not be long enough for a lot of retirees, especially those retiring in their early to mid-60s, or younger through early retirement movements. If you actually need your money to last 35 years instead of 30, a withdrawal rate that worked for the shorter time frame starts to look meaningfully riskier for the longer one. This alone is a real crack in the 4% forever narrative, but it's not even the biggest problem. Problem 2. The data was built on one of the luckiest stock markets in history. Here's the deeper issue, and it's the one that really matters. The original research was based entirely on U.S. stock and bond data, and looking backward, we know the U.S. has been one of the best performing equity markets in the world over the last century. But here's the key question. Was that performance representative of what we should expect going forward? Or was a meaningful part of it just good fortune? There's actually a name for part of this puzzle. Economists have long noted that U.S. stock returns have been higher than standard economic models would predict. A phenomenon researchers call the equity premium puzzle. Think about it this way. The U.S. was not heavily damaged on its own soil during either World War. The Cuban Missile Crisis, which could have triggered a catastrophic outcome, was resolved peacefully. U.S. investors were compensated for the risk that disasters like these could have happened, and then also benefited from the fact that they simply didn't. Researchers have actually quantified this. One study modeling the perspective of a U.S. investor, starting in 1920, found that the realized historical return on U.S. stocks exceeded the return investors should have rationally expected by about 2 percentage points a year. Roughly half of that gap came down to plain luck, cash flows turning out better than expected, because disasters didn't materialize. The other half came from investors gradually lowering their required returns over time, precisely because catastrophes kept not happening, which pushed valuations higher and higher. In plain terms, Assuming the future will look like U.S. history isn't just a bet that good things will keep happening. It's a bet that there will be enough good luck to outweigh the fact that expected future returns are already lower than what that historical run implied. The fix. Looking at a full, unbiased global sample. So how do researchers try to correct for this? By not just looking at the winner. A more rigorous 2022 study took a genuinely global approach. It used real return data covering roughly 2,500 country years of stock and bond performance across 38 developed countries, from 1890 all the way to 2019, deliberately including countries whose markets underperformed, or in some historical cases, failed entirely, and which usually get left out of easier, US-only datasets. The researchers tested a range of portfolios, from all bonds to all stocks, including a common 60% stock, 40% bond mix, and even target date style funds that shift more conservative over time. Instead of assuming one fixed 30-year retirement, they used official U.S. mortality tables to build in real longevity risk, because how long you'll actually live in retirement is genuinely uncertain, not fixed. For context on just how uncertain, for a 65-year-old couple in 2022, the average life expectancy in retirement was estimated at roughly 24.7 years. But the range was enormous. In the unluckiest 5% of cases, one member of the couple was gone within about 12 years. In the luckiest 5%, at least one person lived past 35 years into retirement. Any safe withdrawal analysis that ignores that range is missing something critical. The headline number, 2.26%, and how it improves. Using this broader, longevity-adjusted, globally diversified dataset, the researchers found that a 65-year-old couple following the traditional 4% rule had roughly a 1 in 6 chance of running out of money before death, a far higher risk than most people assume they're taking when they hear 4% is safe. To bring that risk of running out down to a more conservative 5% chance, the safe withdrawal rate for a purely domestic U.S. stock and bond portfolio came out to about 2.26%, dramatically lower than 4%. But here's some genuinely good news buried in the data. Adding international stock diversification meaningfully improves the picture. Shifting a portion of the equity side of a 60-40 portfolio into international stocks pushed the safe withdrawal rate up to around 2.85%. Going even further into international diversification pushed it up to about 3.02%, and that already accounts for the modestly higher costs typically associated with international investing. The clear takeaway here, home country bias, sticking entirely to U.S. stocks, isn't just a diversification nice to have. In this research, it directly limits how much you can safely spend. One more adjustment. Today's retirees will live even longer. There's one more layer worth understanding. Life expectancy keeps rising. That same 2022 estimate of about 24.7 years in retirement for a 65-year-old couple is expected to stretch to around 27.6 years for people retiring decades from now, and closer to 28.7 years for today's newborns once they eventually retire. Longer expected retirements mean your money needs to stretch further, which pushes the safe spending number down again. Putting it all together, a globally diversified 60-40 portfolio, adjusted for the longer retirement horizons, today's younger people should realistically expect, lands at a safe withdrawal rate of roughly 2.7%. That's the number that gives this video its name, and it's meaningfully more conservative than the 4% figure most people have built their entire retirement mental model around. Why this isn't as scary as it sounds. I know this is a lot to take in, so let's put it in perspective, because this research, while sobering, comes with genuinely reassuring context. Fixed, inflation-adjusted withdrawal rates like these are really more of an academic modeling tool than something real retirees actually follow. In practice, almost nobody blindly withdraws the exact same inflation-adjusted amount every single year all the way down to zero while they're still alive. Real people adjust. If markets have a rough stretch, most retirees naturally spend a bit less that year. If a market boom happens, some feel comfortable spending more. On top of that, your required portfolio withdrawals typically shrink over time as other income sources kick in. Most notably, government retirement benefits like Social Security, especially if you're able to delay claiming them to increase the payout. That income acts as a natural hedge against the very risk we're discussing, living longer than expected. There's also solid evidence that retirees, in practice, tend to increase their spending a bit slower than inflation over time, often trailing it by roughly a percentage point, which is different from what these rigid models assume. And there are other tools available too, like allocating a portion of a portfolio to an annuity to convert some assets into guaranteed lifetime income. The practical takeaway. So here's what I want you to actually walk away with, not just the scary headline number. First, if your retirement plan is built entirely around spending 4% with no flexibility, it's worth stress testing that against more conservative, globally diversified research like this. Second, genuine international diversification isn't just a portfolio nice to have. In this research, it's one of the most effective ways to improve your realistic safe spending rate. And third, withdrawal rates are a useful planning input, not a rigid life sentence. Real flexibility in your spending, combined with other income sources like delayed Social Security, meaningfully changes the actual risk you're facing. This isn't personalized advice. Everyone's specific mix of assets, income sources, and life expectancy is different. But understanding this research gives you a much more realistic starting point for a conversation with a financial planner. Closing plus CTA. If this changed how you think about that 4% forever number, that's exactly what this channel is here for. Retirement planning deserves real, honest numbers, not just the version that's easiest to repeat. Hit subscribe because I'll be doing a follow-up video specifically on why international diversification matters this much. It's a big enough topic to deserve its own deep dive. Drop a comment and let me know. Does 2.7% change how you're thinking about your own number? I read every comment, so I'll see you down there. This is Sara Retires. I'll see you in the next one.